Good morning, listeners, and welcome to the Trade Talk podcast. On Wall Street, the Dow Jones Index posted its biggest fall in almost 9 months. It lost 726 points to close at 33,962. The sharp rise in COVID 19 Delta infections worldwide appears to have revived concerns about renewed shutdowns and a delayed economic recovery, sending investors fleeing for safety. Markets are worried about economic recovery. Meanwhile, the yields on America's 10-year Treasury bonds slipped to a 5 month low of 1.17% from 1.35%. That shows investors are fleeing for safety. They are selling equities and buying bonds. Oil slumped by about $5 a barrel overnight, closing out its worst day since March. It is trading at 69 a barrel. And the dollar index moved to the levels of 93.03 before settling at 92.85, which is negative. Broadly, we are of the view that if we see the major factors, then except dollar index, other like fall in bond yield and fall in crude prices are positive for emerging markets, but this particular strength of dollar index is negative because it always attracts some more outflows. Currently, the dollar index is around 93 levels and the previous high was around 93.50. So it is very close to that previous high, and technically whenever we see any instrument or any asset class which is very close to its previous high, it comes under some pressure. So we may see some cool off activity in the dollar index also, but till now there is no as such any reversal sort of formation, so we need to be a little bit careful. Now if we go through with our markets, then on Monday the top losers were the bank Nifty and the metal sector, while the gainers were the pharma and the real estate sector. Although the market survived at 15,700 levels, the closing was not that encouraging. In addition to that, the market failed to close above the support levels of 20 days simple moving average and 20 days exponential moving average, that was around 15,785 and 15,765 levels respectively. Today, the market must hold above the levels of 15,600. On the dismissal of the same, the Nifty would fall to 15,500 or 15,450 levels, where it has next level of important supports. We need Nifty to cross the level of 15,840, which was yesterday's highest level for the bullishness in the market. Our advice is to buy select stocks with a medium term view, and for traders our advice is to create long positions only based on reversal formation. So till we are not seeing any reversal formation, it is better to stay away. Do not try to catch the falling knife. But for investors, certainly it's a time to invest in strong companies on major dips, as the major and broader trend of the market is still bullish. That's all from my side. With this, I'm ending today's morning podcast. Thank you very much for listening in and have a excellent day to all of you.